Hello, morning.
Good morning, Professor.
Hello, Professor. Good morning.
Morning.
Good morning.
Morning, guys. Let me. No, I hope everybody is doing well. Let me open here our e-class as usual to show you where we are and how we're gonna move on in this course. Just a minute, hold on. There you are. Well, guys, today we're gonna keep discussing supply chain finance strategies. We are on April 27, and today we're gonna talk a bit about securitization, which is a structured finance operation very usual in Brazil in the real estate and agribusiness, and this is strictly linked to the relation between selling and buying in supply chains. Okay, this is another important tool for the firms that need to finance customers or to finance or to provide a term to suppliers. Okay, we're gonna go deep on this. Next week, May 4th, is our last class on supply chain finance. We're gonna discuss a last solution on supply chain finance, and after that, from May 11th onwards, we start discussing our 4 cases. Okay, then we have basically 2 weeks to start this new stage and last stage of our course. Well, all being said, let me open here material that I will use as support. This is available for you if you like. Let me open here also my whiteboard for a minute.
Progress.
All right, let's go. The role of securitization in supply chain finance. Securitization is a name that is most used in Brazil. It comes from securitização, okay, which is nothing to do with seguros, with insurance. Okay, but in English, in North America, basically mostly, this is very common to be named as factoring. Okay, as factoring. So factoring, or in Brazil, securitization. North American also understand securitization, but as I said, not very common for them. Um, is I would say a very admittedly important operation for the firms that need to sell at term, or even for the firms that need to buy, making cash upfront payments. So in both cases, we have a firm like that. What I mean is we have something like that. Hold on. We have something like the leading firm. Oops. We have the leading firm. Okay. And as I said, securitization is a important financing tool or financing tool for the ones that need to sell to customers at term. So I ship you in D0 or D+0, and the customer pays me in D plus X or N. Okay, so to mitigate the gap that this firm has while offering this solution, financing gap, cash gap, we can use securitization. But also for the relation between leading firm and supplier, as I said. It is very common in some industries, in some supply chains, that the leading firm need to eventually make upfront payments in order to boost supplier production or whatever. I repeat, in Apple's case that we're going to discuss even wrong in the first, with the first group one, Apple adopts this type of strategy in order to tie the supplier. So Apple ties the supplier, guarantee the production of the supplier by basically financing him by making upfront payments. Okay, and we have this situation in a wide range of industries. Okay, so when the firm adopts this strategy of making upfront payments to the supplier, again, this firm will face a certain type of cash gap. And this cash gap can be fulfilled by securitization, can be fulfilled by vendor and compra, as we've seen in our last class, but it also can be fulfilled by securitization. Okay, so this is what this scenario, the conceptual framework in which we're going to discuss these important type of operation available in the financial markets, securitization. All right, let me get back to the presentation. There we are. This is our agenda for today, guys. Okay, we're gonna talk about sources of funding. Actually, we're gonna make just a refresh on this: securitization versus balance sheet, types of bonds, types of securitization, risk structures. Again, refresh, because this is exactly the same as we discussed for corporate and vendor finance, and some examples of issuances that we've already had in Brazil. There we are. This illustration is already familiar for you. We have here our firm's pocket, and here we have the indication of the ways in which a firm may raise money. Debt, the most traditional, as we've seen, through banks. Equity, which is basically the investment that the shareholders make in the company. Sale of assets, we're going to see this next week. And the subject of today, which is securitization. Basically, guys, what is securitization? What's the intent of securitization? Securitization intends to sell the receivables. If a firm makes, as I was shown 2 minutes ago, is if a firm makes several sales with deferred or with at term, with payment being done at term, this firm will fatally face an increase in the account receivables. We've discussed this. We know that this is when these account receivables increases a lot, this may be a problem for the firm for the reasons we've discussed. And because of that, for some firms, this is very desirable that they could sell these to the market in order to convert, in this case, for example, 66 million reais into cash. Always is good, is better to have cash instead of account receivables, okay? Securitization comes to support those firms to increase liquidity, to increase the way, or better, to increase the balance sheet shape. Go ahead, Gabriel, please.
There's just something to understand. Why would anyone buy the accounts receivable? Would it be in hope that they would get interest on a late payment? Is that why they buy to, like, they can calculate the price in function of a credit and therefore get a fair market price based on how much interest they may get from it?
Yeah, the logic behind investors' mind is the following. This is, by the way, a very important question. First, before getting into your question, let me make an introduction. Everybody may buy a securitization bond. Anyone, okay? It's not open for it, although everybody may buy. Eventually, this is a operation that is more focused on people that have a minimum of cash availability, because sometimes the minimum ticket is high. So eventually you're not gonna be able to buy. But generally speaking, okay, CRAs, I will explain this, and CRI are available at the home broker of any standard broker. Okay, this is the print screen of Rico. Here I've seen, I don't know exactly when I made this image, but it was months ago. We have here one CRA, which is Certificado de Recebíveis do Agronegócio, Agribusiness Receivable Certification. So it's a bond issued by one firm named Vamos that had several account receivables and packed those account receivables into a CRA, a tradable bond to be sold to investors like me, like you guys. Okay. Same thing, this one, CRA from BRF, very famous firm. Okay. Here we have a real estate receivables certification from BR Properties SA. Same thing as CRA, but for real estate industry. Okay, same thing. With a minimum ticket of 1,000 reais, you can buy a CRA issued by BR Properties SA and get from this 130% of CDI. Okay. The question Gabriel made is, what's the interest? What motivates an investor to invest in this type of investment? We have some advantages of investing this. First, this is a fixed income investment. Okay, this is not a multi-market or a stock market investment. This is a fixed income investment with a certain type of risk. Why we have risk in this type of operation? Because basically a CRA or a CRI are backed by receivables, and we understand that the receivables carry with them risk of the debtors not to pay. So although we have this environment of uncertainty or a certain level of risk, this is considered a fixed income investment. This is a fixed income investment because this is basically a investment that pays to the investor a flat rate or a pre and post rate, but well known. So always with the feature of fixed income. How the investor gets money on these? What's the magic here? Look, let me get back here. 1 minute. Here, look. Let's suppose that let's get these numbers as example. This firm has 66 million reais account receivables. Let's imagine that this amount includes the principal plus the interest rate that this firm charged from the customers. Okay, let's imagine that we have here 50 million reais principal plus 16 million reais interest rate. Okay, just to make our math easier. This firm will sell these receivables into the capital market through a CRA or through a CRI, depending on the industry this firm is part of. The investors will look these receivables, will look the structure behind the CRA or behind the CRI. I will explain in a few minutes will exemplify some structures. The investor will make the assessment on the quality of the receivables and the quality of the structures, and will say, hey, I can advance you 66 million, you want? No problem. I can advance you 66 million reais cash now. Or better, you want to sell these 66 million? No problem. No problem. Look, I will advance you now here, cash in hands, buying your bond by 40 million reais. Well, the firm sold 66 million reais, being 50 million reais principal, equipment, products, and 16 million reais interest rate. The investors are requesting basically 66 million reais minus 40 million reais. They are asking 26 million reais interest rate. What the investor asks, guys, what the idea here actually, the idea here is to the investor to apply a discount rate on the receivables. So at maturity date of the receivables, the investors will receive 66 million reais coming from the debtors. But the investor provided to the firm 40 million reais in advance when they bought the bond. So they applied 40 million reais and they got at the end of the period 66 million reais. So this is the math behind the securitization. The investors price a discount rate against the full amount of the receivables, including the interest rate. And then it is up to the firm to accept or not that. This discount rate will be higher as higher is the risk structure of the operation. Kind of we saw last week. Remember, risk sharing, first loss, full guarantee. So depending on the structure that we have to provide security or to mitigate the risk of the operation, lower will be the discount rate the investors will apply to this operation. And the opposite is also true. Not sure if I answered your question, Gabriel.
Yes, thank you.
No problem. So guys, we have here in Brazil basically two types of bonds that are backed by securitization facilities. As I said, agribusiness receivable certification and real estate receivable certification. Why we have this type of structure for these two specifically to these two industries? Just because, guys, those two industries are historically subsidized by the government. So when you want to buy a apartment or a house, if it was years ago, you probably would go to the Caixa Econômica Federal or to another bank and would try to get a financing from the national housing system, Sistema Nacional de Habitação, which probably would be subsidized. So it's subsidized by the National Treasury, so the National Treasury is taking the hit. If Caixa Econômica Federal is providing a, I don't know, 9% interest rate to someone to buy an apartment and the base rate is 15%, there is a outstanding balance that is being paid by someone, basically by the Treasury, by the National Treasury. Same thing happens with the agribusiness. Happened with the agribusiness. Agribusiness always was highly subsidized through credit. And well, then we got 2014, 2015, 2016. We had that situation with our prior president, Dilma Rousseff. She fell basically because of the level of subsidies to some industries, mostly to agribusiness. Okay, and after that, Brazil needed to finally put the responsibility to finance agribusiness and real estate in the private market's hands. So what Brazil created, actually, we already had these before 2015, 2014, but this type of structure, securitization, got a boost from this period onwards. When government said, you know, I will decrease the base rate, and I will not subsidize anymore any sector, or I will not subsidize in a high level or any sector. So if someone from agribusiness needs cash, they need to go to the bank and make a debt, or they need to go to the shareholder asking equity, or they need to create or to issue a bond in the capital market, eventually through securitization. Same thing with the real estate. In order to motivate firms to engage in issuing securitization bonds, and in order mostly to incentivize investors to buy those type of bonds, government established a tax income free for the yields coming from those two types. So when we see that this CRA is paying 4.1 plus IPCA, it is net on the investor's pocket. When BRF is proposing to pay 4% plus IPCA, again, net profit to the investor's pocket. You don't need, or the investor doesn't need to consider the income tax rate. Okay, same thing here. So this is the advantage for the ones that decide to buy a fixed income bond coming from securitization from agribusiness or from real estate. The point here is that, I mean, the one that is buying this CRA or the one that is buying this CRA or the one that is buying this CRI need to understand the features, the structure, risk structure of them in order to understand if the risk is high or if the risk is low. For that end, let me give you an example on how a firm may get access to this. All the securitization guys, all of them, CRAs or CRIs that are issued in the capital markets have a document like that. A preliminary prospect or a definite permanent prospect explaining in detail. This one have 500 pages in detail all the aspects related to this issuance. In this case, we have as securitization company Ecoagro, as the firm that holds the receivables, VLE. For the ones, I don't know if everybody knows VLE. VLE is an important railroad player in Brazil. Okay, it was an older prior to be a independent firm. It was the logistics arm of Vale. Today, this is a completely independent firm that have a bunch of railroad lines operated by them. Let me just turn off my mobile. So VLI issued a CRA of 260 million reais. They had at least 260 million reais in their balance sheet as account receivables. Account receivables coming from when? From where? If they are a service provider. If you want to understand this question, you need to go to the summary of this document. And here you're going to see everything, all the details. But one important detail that we have is this one, structure of the securitization, page 39. Here you're going to understand how the receivables flow from VLI to the investors in detail. So the receivables that back this operation are coming from VLI and firm or firms relationship. VLI has relationship with some firms. Which firms are that? Those firms are firms that hire VLI to make the transportation through railroad of several cargoes, like soybeans, like fuel. As we have here a CRA, probably all those firms hire VLI to make the transportation of agricultural products. Otherwise, it could not be issued under the CRA umbrella. So VLI has probably several take-or-pay contracts, long-term contracts in which the firm hire VLI to make the movement, to make the transportation of products over 2, 3, 4, even 5 years. So it's a long-term contract. It's very common in the railroad sector, take or pay contracts. This is a pure receivables because VLI knows that they will transport grains from this firm over 3, 4, 5 years. But they didn't get yet the money from these contracts. They will get the money as soon as the transportation happens over the years. But the contract per se is already a receivable. VLI will receive for the transportation that they will make with in the future as a service provided to the firm A, B, C, and D. What VLI done? Packed those contracts into a CRA, made the assignment to Ecoagro, which is the securitization company responsible for this CRA. Ecoagro offered the CRA to investors by themselves and using XP and Itaú BBA. I will explain the difference between both cases. Those guys bought the CRA. The cash flew to Ecoagro, which flew to VLI. In the future, in the maturity date of the contract, firms will pay VLI, VLI will pay Ecoagro, Ecoagro will pay the investors. So here it is explained in detail how the receivables that make that origin, that originate the CRA is established. And here, just here, we see how the structure is guaranteed. VLI will issue a CDCA backed by a credit right, having VLI as guarantor. So VLI is guaranteeing 100% of the receivable. So ultimately, those guys here are taking VLI's credit risk. This is very important. VLI is the guarantor of all of these operations. If you remember from our class of last week, we've discussed this. So this is very important to make this deep, if you are an investor, to make this deep assessment in order to understand if the remuneration that they are offering to the investors worth or not the risk. Okay, this is just one example. All the CRAs, all the CRIs have this type of document, prospect. Okay, well, we have, guys, two different ways to issue a securitization bond. Two ways. We can issue using the instruction CVM 400 or the instruction CVM 476. The difference between both of them, basically one. This one is tougher, have rules that are tougher than this one. Why? Why? If a firm decides to issue a CRA or a CRI using CVM 400, CVM 400, this firm is saying that he wishes to issue this bond to the to individuals, to investors that are not family offices or qualified investors. They want to offer the CRA or the CRI using the home broker of Itaú, of Bradesco, of Rico, of XP. they want to offer to individuals like ourselves, which are not very experienced in this type of investment. CVM understands that, well, if a firm will make a securitization aimed to individuals, the structure behind this securitization needs to be very safe to the investors, because investors doesn't know deeply all the risks involved in an operation like that. On the other hand, a firm may choose to issue a securitization bond using CVM 476. In this case, rules are less rigorous. Why? Because this type of securitization just can be issued against qualified and professional investors. Qualified investors are investors that have at least 1 million reais investment in capital markets, not in stocks, not in fixed income, not in funds, in capital markets. Sorry, funds is considered capital markets, not in stocks, not in fixed income like CDBs or LCAs, LCIs. Professional investors are the ones that have at least 10 million reais investments of this type. So those guys here are judged to be, or to have the experience, the enough experience to make the assessment, this type of assessment that we are doing here. This type of assessment that we are doing here. What's the risk involved with the operation? Okay. Basically, one of the most important differences between CVM 400 and CVM 446 is that in this one, all the structure of the CRA or of the CRI need to be rated. They need to have a rating from S&P, from Moody's, or etc. So you see the rating, and well, the rating coming from an experienced house make you a ordinary investor a bit more comfortable investing or not in that option. Here, we don't have it, or we don't have the need to have it. A firm to make the rating of the operation will pay a lot. So the structure will be more expensive to the firm that has the account receivables. Okay. Basically, guys, large corporations with a strong name in the market generally issue under CVM 400. Smaller firms that are not known among the individuals, among the society in general, generally issue using CVM 476. Why? Because for the large corporations, it is easy when an investor like me or like you guys open your home broker and you see that BRF is issuing a CRA, you know BRF. You know BRF. More or less, but you know that. You know that this is a very important multinational Brazilian multinational firm, very well structured, etc., etc., etc. So the name attracts the investor. Here, the small firms that don't have this strength go door to door to talk with each investor to present the structure. They make a very complete roadshow, and generally, this issuance is bought by 50, 60, 40 different investors, most. Here we can have hundreds of people buying. Well, if we have hundreds of people buying, it is expected that the cost is, for the firm, the discount rate is lower than in the solution here. Okay. CVM 400, CVM 460.76. Any question, guys? Any comment up to now? No? All right. All right. Here I'll pass fast because I mean we've discussed this in detail last week. Okay, but just to mention that the same logic of the vendor and compra finance works for securitization. We're gonna see in the examples I brought. A firm may offer full guarantee over the total amount of the securitization, like VLI did. A firm may offer a risk sharing, or the firm may offer a first loss, which is the most common, as in vendor and compra finance. Okay. Here, guys, this is the first example that I would like to bring you to show a typical flow in a CRI securitization. So this is a securitization that happened within the real estate industry. Look, we have here Via Varejo, very famous retailer in Brazil, owner of Casas Bahia and Ponto Frio. Okay. Via Varejo rented some infrastructure from W.T. Goodman, corporate floors or logistics, warehouses, whatever. They have between Via Varejo and W.T. Goodman, they have a receivable. This guy have a receivable that is owned by Via Varejo. Which receivable is that? It's a rental contract of a number of years duration. Okay, so this guy knows that we'll receive money from Via Varejo in a monthly basis due to the rental of some facilities that is owned by them. Here, the situation is pretty similar to VLI. What this guy made, he said, I need the cash now. I can't wait 5, 6, 7, 10 years. I need all the cash related to this contract now. So they packed this contract or this contract into a CRI, made the assignment, assigned it to Gaia. Gaia is another important securitization firm here in Brazil. Gaia sold the CRA backed by those contracts to investors. Investors paid for that, requesting a discount rate. Gaia sent the money to W.T. Goodman. At maturity date, Via Varejo, instead of paying W.T. Goodman, will pay Gaia, that will pay investors. This is the first example within the real estate industry. Here, another interesting now CRA. Look, it's a CRA of Burger King. Burger King in Brazil already issued a CRA. Very interesting, right? What Burger King has to do with agribusiness?
It's primary source.
It's primary source, yeah. Look, in order to affirm to issue a CRI or a CRA, this firm needs to prove that the receivables come from real estate or comes from agribusiness. Burger King proved, as Matheus said, that they have receivables coming from agribusiness. Basically, the meat that is used to make the hamburgers are products coming from agribusiness, basically from firms like JBS, JBS. Okay. So Burger King found this. Burger King is not anyone. It's an important multinational firm that deployed this solution to help its balance sheet. And what's the structure in a very, very summarized way? Burger King had contracts with suppliers, basically meat. Okay, with JBS, I read the prospect and saw that basically the main supplier that justifies the CRA is JBS and Seara, which is a firm from JBS. So they have long-term contracts for meat supply. Burger King, here they made a little bit different. They didn't package the contract per se into the CRA. They issued a debenture. Justifying that the cash coming from this debenture would be used to pay the suppliers. A slight difference. Okay. And why is that? Because Burger King wanted to take 100% of the risk of the relation between them and the supplier and show to the market that, hey, you are running Burger King risk. You are not running receivables risk. Because of that, they decided to make the debentures CRA, the issuance of the debentures justified or aiming to using this money to pay the suppliers. And of course, this is not an incentivized debenture. So if Burger King simply issued a debentures, probably the investors would have to pay income tax. Within CRA, they don't need to pay income tax. Okay, if I issue incentivized debentures from infrastructure or whatever, is free of tax. But a simple debenture from a firm is not free of tax. When the debenture is inside the CRA as the receivable that justifies the CRA, then the CRA is a tax-free investment for the investor, debentures becomes also free of tax. So they issued those debentures justified by the contract with the supplier, and they assigned those debentures to the Caesar, which is basically Ecoagro. It's a branch of Ecoagro. So they assigned the receivables to Ecoagro. Ecoagro, same thing, packed those receivables into a CRA, sold to investors directly. If it is directly, means that it was under CVM 476, and if they used XP, means that probably they also sold under CVM 400. Those guys paid for that, which the money went to Burger King. In the moment Burger King needed to pay, of course, they got this money and paid for the suppliers. And in the moment Burger King needed to pay the suppliers ahead, they paid back the investors. So here is a relation where we don't have account receivables, but we have account payables. Account payables. Those guys are requesting cash payment. This guy said, I don't want to pay cash. I want to pay you deferred. So both of them basically work together to issue the CRA. In this case, those guys got the cash payment coming from the investors as they wanted, and this guy here got the term to pay for the meat as he wanted. Okay. Here another example, VLI, I will pass as we discussed. Okay, but here you see that same thing. Ecoagro sold CRA directly to investors and also using Itaú BBA and XP. Okay. Here another interesting CRA then issued by a very small firm. Nobody knows probably Peninsula Fertilizer. This is a firm that provides fertilizers to farmers. Here the idea is the same. Farmers need fertilizers, but they don't want to pay fertilizers in cash. They want to pay after they harvest the crops. So Peninsula sold that way, supplying the fertilizer in the moment it was sold, and giving to the farmers payment term, conceding payment term to the farmers, 90 days, 120 or 150 days. This is a receivable between farmers and Peninsula. Peninsula assigned the receivables to Octante, another important securitization firm in Brazil. Octante packed those receivables into a CRA and sold to qualified investors, which paid for that, At maturity date, instead of paying Peninsula, farmers paid directly Octante, which paid the investors. I put this structure here for you guys to show you the risk structure. So this one, we don't know Peninsula, we don't know. I'm not comfortable to invest in this area because I don't know Peninsula and I don't know agribusiness. So if you go to the prospect, you're gonna see a figure, a illustration like that, which is exactly this stuff here. Let's see how the risk is managed in this 50 million reais CRA. First loss, named CRA, subordinated quota. First loss, 12% is taken by Peninsula. So the first loss, 12%, which is a reasonable percentage, is taken by Peninsula. The second loss, which is named CRA mezzanine or CRO CRA mezzanino, is taken by private acquirers, private buyers, which is basically professional investors. They are taking the second loss. So after 12% default, they start to lose money. And this CRA is divided into a third tranche, which is the senior quota. The senior quota was sold to qualified investors, those guys that have until 1 million reais investment. And look, in addition to being the third tranche of risk, so these guys need to lose 12%. These guys here need to lose the other 80%. So after 20% loss, those guys would start to losing money. So only for this, this structure would be already, or this structure would bring a certain type of safety to the senior investors. But in addition to that, Peninsula is offering a credit insurance for the senior and for the mass as well. So as soon as 12% of the structure, 12% of 50 million defaults, instead of losing money, the mezzanine will be paid by the credit insurance, AIG. And the same thing happens with the senior. Having a credit insurance in the facility the assessment is twofold. It makes the structure more expensive because you need to pay for the insurance, but you have the potential to decrease the discount rate that these guys request, because this is safety. Sorry, because this is safe. So in one hand, you have a cost increase with the insurance. On the other hand, you may have a drop in the discount rate that is going to be applied to the 50 million requested by the senior and by the mass. The math here is to check if the drop in the discount rate is higher than the cost of insurance or not. Okay. Of course, in this case, we have Peninsula taking the first loss, but eventually it could be a family office, a professional investor taking the first loss. If it was the case, this investor would request a very high rate to take this part of the risk. Okay. And here, guys, I wanted to show you actually those four actually CRAs and this one CRI to exemplify, okay, a bit on what happens in Brazil in the capital markets. Securitization at the end of the day is a solution provided by the capital markets to the firms that need to keep financing their customers or making upfront payments to the suppliers, and because of that they need money. So securitization company is an option when debt is unavailable, or when debt is expensive, when equity is unavailable. And when, of course, you don't have that type of solutions like vendor or comfort. All right. Any comment, folks? Any question? Any doubt? Oops. No. If there is no doubt, let me make the check, the check of the presence quickly, and then I make you free. André?
Here.
Arthur?
I'm here, Professor.
Bruna? Bruno Carpinelli?
Here.
Bruno Cunha. Bruno Cunha. Camila Freitas.
Here.
Carolina.
Here, Professor.
Cristiano. Diego. Fernando. Gabriel is there. Gustavo. Hector.
Here, Professor.
Isabela.
Here.
Jenny cai em Chu. Juliana.
Here, Professor.
Lucas Lixando.
Hello, Professor. I'm here.
Hello, Lucas. Lucas Botino.
Here. How you doing, Professor?
Great. Maria de Carvalho Fernandes. Maria. Maria Eugênia Noronha.
I'm here.
Maria Luísa.
Here, Professor.
Ok. Marina.
Hi, Professor. I'm here.
Hi, Marina. Lúcio, Mário.
Hi, Daniel.
Okay, Mário. Matheus is there. Matheus Lencastro is there. Matheus Guedes. Rafael.
Here.
Renan.
Hi, Professor.
Hey, Renan. Roberto.
I'm here.
Victor.
Yes, sir.
Hey, Victor. And lastly, William. No. All right, guys. If you, Maria Fernandez is there. Okay. All right, folks. If you don't have any other comments or suggestion, I wish you a great week. Get prepared for the presentations, okay? Again, we have 2 weeks for that. And keep safe and see you soon.
Bye-bye.
Bye-bye.
Bye.
Bye-bye.
Bye, Professor.
Thanks.
Bye, Professor.
Bye. Thank you.
Ciao, ciao.
Bye-bye.
Professor, could you stay like